Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Wednesday, August 24th, 5:27 p.m. Eastern Time, coming to you from the financial capital of the world, St. Augustine Beach, Florida, with tonight's Revere Market Insight video. State of the market. We are in an uptrend, really a rebound uptrend off the lows in a bear market, but a cautious uptrend because we met strong resistance at the declining 200-day moving average on most of the indexes and have reversed lower off of that resistance. And now we are battling a heavy battle at the short-term 21-day exponential moving average. Large cap indexes can't seem to get back above it. The mid and small cap indexes are playing ping pong above and below it. Leaders holding up okay, but uptrend with caution, and it seems like we're coiling and waiting for the reaction to Jerome Powell's Jackson Hole speech Friday morning at 10 a.m. So let's check over here on the trend gauge. Leaders, neutral. We had some damage done last week and early this week. They've rebounded pretty well. Tuesday and Wednesday holding up okay, so we'll keep that in the neutral column. Short term, as I said, we've got the three big cap moving averages under the 21. Mid cap and small cap reclaimed them today, so we're neutral there. All five of the major indexes are trending above their medium term 50-day moving average. All five are below their long term 200-day moving average. And why are we overly concerned with the 200-day moving average? Because this is where all severe bear markets take place. So let's bring in the chart that I tuck under my pillow every night. Believe it or not, there are advisors out there that are okay with these massive drawdowns during severe bear markets. We at Revere are not. We take the concept of sequence of returns very seriously, especially if you're approaching retirement. You think you've got a nice nest egg tucked away, and bam, you're hit with a big drawdown, a big bear market, and you don't have time to recover from it because your retirement's about to start. This is what we specialize in. This is why we have buy rules and sell rules, and our biggest sell rule is to get maximally defensive when we're under the 200-day moving average, and we'll dip some toes back into the water when we get above short-term moving averages. But this is what you have to do, is fear the bear and stay tuned to us, and we can guide you through the way. Let's get into the numbers of today. What just happened today? Day three of a tight range. As I said, S&P and Nasdaq 100 under the 21-day exponential moving average, but a good close. Small and mid growth outperformed today. G6, that's our in-house composite of 6 growth ETFs, up 1.2% on the day. S&P 500 up 1/3%, Nasdaq 100 up 1/3%, Dow up 0.2, mid caps up 0.5, Russell 2000 up 0.8, Global Diversified 60/40 stock and bond just barely positive. In-house GROTECTION, our flagship portfolio, up approximately 0.39% on the day. Let's get into the tail of the tape, and let's get into some charts, but let's also get into an example of what I'm talking about with trend following. A lot of people derisively call it market timing. We call it common sense. The market, when anything in your life is going well, great. When it starts to turn south and you don't take corrective action, you're a fool. We think the same about your investments. So if the markets are fine, trending higher above the 3 key moving averages, nothing to worry about. We start going into a consolidation sideways, worry a little bit, maybe take some off the table. If you start rolling over and the short term and the medium term moving averages start to roll over and get a negative slope, and you get below this black line, the 200-day moving average, as I said, it's time to really take stock of what could possibly happen, because this is where all of the big bad bear markets occur. Without fail, they always occur beneath the 200-day moving average. On average, these big declines start about 12% off the high, 12% above the 200-day moving average. You get down there, you get a weekly close below the 200, We've got rules telling us to act on it. We've also got rules telling us when to get back in, such as when we got back in back here on 715. Rode SSO up. This is the two-time S&P 500 instrument, rode it up for 20% gains up to the declining 200-day moving average. We've been getting more defensive since then, watching this pullback, and we broke below the 21. That's a short-term sell signal. So we've hedged our SSO position, waiting to see how this resolves. This is a very tight range. We want to see which way this resolves. It could be lower, could be higher. If it's higher, we're ready to respond to either outcome. We're not going to predict which way, but tight moves in the market are always followed by trending moves. Markets can only do one of two things: trend higher, trend lower, or go sideways or consolidate. Right now, we've got a tight 3-day consolidation here. We're waiting to see how this is going to resolve. So there's the S&P 500. How about the Nasdaq 100? Same situation, tight 3 days below the 21-day moving average. How about the Dow Jones Industrial Average? Got a couple closes above the 200-day moving average last week. Now we're struggling to get back above the 21, closing below it again. Mid caps had a few more closes above the 200-day moving average. We're battling right at the short-term 21-day moving average for mid caps. IWM, small caps, same thing, battling right around this flat, no slope, flat 21-day exponential moving average. So really, market appears to be in a holding pattern, waiting for what St. Jerome says on Friday at the big Jackson Hole Economic Conference. So let's go to the tail of the tape now. We'll dive a little bit deeper into what's going on with the markets. Same headwinds we've been dealing with for a while: strong dollar, inflation, Fed tapering, and a balance sheet reduction. Rising interest rates, Russia-Ukraine war. Add on top of that some negative technical indicators. With the dollar near 5-week highs, the McClellan Summation Index has hooked down from overbought. That's a headwind historically. All 5 major indexes with a daily stochastic sell signal. We're going back and forth between the bear case and the bull case here. Rally's not over, but we have broken below the 21-day moving average as of 8:23, with the second close below on the Nasdaq and the S&P 500. So the bulls and bears are battling it out right now. A little bit of news after the close yesterday: Fed hawk Kashkari said tightening must continue until inflation gets down to 2%. Well, the market doesn't seem to be accepting that they have to keep raising interest rates, but it doesn't matter what I think. What matters is what the charts ultimately end up showing, and we just weigh if there's any negative or positive reaction to some of these comments by the Fed committee and by the FOMC chair Powell. But I guarantee you there'll be a reaction Friday when Powell gives this speech. A little bit more news: Japan mentioned, because nat gas is out of control over there too. It's not just in Europe. They're going to restart some of their nuke plants. That led uranium, the URNM ETF, to have a stellar day. So coming into today, expectations neutral since that 810 breakout failed and us being under the 21-day exponential moving average. Continued tight consolidation today, range bound, as I mentioned, battling around support and resistance both on the S&P 500 and the Nasdaq. A couple of names we were looking at coming into the day: CMG. We want this to either bounce at the 21 or get back above the ADMA. It did neither today, but it remains high on our buy list. ANET. Let's take a look at the charts of these. What the heck? Here's CMG. You can see a very nice run up after earnings, pulling back now, consolidating in this tight range, just the way the markets are, waiting for the 21 day to catch up. I've got an alert right above the ADMA on this one. ANET is another one that had a nice reaction after earnings, pulling back for 4 days now, tight consolidation. This Powell reaction is probably going to dictate the reaction of both of these stocks. TBT, having initially gapped down yesterday and having a positive outside move off of highs to lows with another gap up today. This continues to be strong. It's not a good thing for the markets, because it means interest rates are continuing to move higher, but rates going higher, dollar going higher, markets not giving it up yet. See what happens on Friday. Here's a move on the action or a breakdown of the action today. Let's go to the S&P 500, go to a 5-minute chart. You can see a false breakdown right out of the gate, that 41.24 area, very tight close Tuesday. Tried to break down immediately, but it was bought, so that's a false breakdown. Let's see if we can go higher. Yes, we did. We broke out here at 11.15, strong move up, moved higher into 41.56, consolidated, and then just promptly rolled over, making it a false breakout. Tried to get back above that 41.40 area, failed, pull back a little bit more. Try to make another run at 41.40, failed, pull back a little bit more. Another run to 41.40, yay, we're above it. We're going to close at the high of the day. No, we're not. We reverse, come down, close right at this 41.40 area. So this tight range between 21.20 and 41.40 has basically dominated the action over the last 2 days. So we'll see which way this resolves. Strong sectors today, oils right out of the gate, solar, uranium. Let's take a look at this URNM chart. You can see forming a big double bottom, strong move up on big volume, led by CCJ. Better looking than the index. So this got a couple of alerts set off on this one today. Didn't buy it. Big volume, like a pullback. But every time something moves up and I'd say I'd like a pullback, it keeps going higher. And well, you know how it goes. You can make the wrong decision all the time. But this certainly has our attention, and it's going to be something that's on our focus list for tomorrow to see how it behaves. Moving on, XME acted well, ITB acted well. Let's take a look at DHI. Look at the shakeout below the 50-day today and the move higher, but that was because Toll Brothers announced earnings, initially had a big shakeout, moved up here to the 50-day moving average, but was rejected at the 50-day moving average. Big volume here. Now, this is an inflection point on Toll. Let's see if it goes higher, breaks above today's high, or if the 50-day moving average serves as resistance for it. And coming back from the dead, biotechs. First, let's look at XBI, the Diversified Biotech Index. Nice day today, trying to get back above this 200-day moving average. Nice move up, pullback, trying to reassert itself. But look what's come back from the dead. MSOS, the U.S. cannabis ETF. Doesn't look good on a chart. Looks good today, as you can see it breaking above this 1220 to 1220 to 1230-ish area, where it's been range bound for a while. This has just been a train wreck. If you've been holding this, maybe some light at the end of the tunnel with this move up, I don't know, but anything that has been moving up below the declining 200-day moving average goes up for a while and then has been failing, and this has a long way to go, 33% up to the declining 200-day moving average. On the weak side today, bonds and retail, Nordstrom's got hit hard today. Really poor retail numbers, and the retail love affair from 2 weeks ago is over. Let's take a look at Walmart. Since it had that big gap up on earnings, it basically gave the entire gain back from where we initially gapped up. We're finding that out with BJ's too, which we bought on this gap up. We sold half of it on the break below the low of the gap up day, still holding a small 1% position in this. Given it a little bit of a chance, we'll see what happens with this going forward, but very small in the portfolio right now. Bonds, TLT, let's take a look at that, and you'll see it making lower lows for the 4th straight day, which means TNX, the 10-year, that's right, higher highs for 4 straight days, back above the 50-day moving average. So this looks a lot like TBT. TBT is a 2 times the IEF. The IEF is actually the 10-year, 7 to 10-year treasury, which has also been lower and broken the 50-day moving average for 4 straight days. So portfolio changes. We added right out of the gate today SWAV. You know, this is one of our favorite stocks, consolidating nicely after this strong 5-day up move. Broke above the 300 level with volume early. Let's take a look at it, a 5-minute chart. When we saw this, we bought it, but it just trickled back lower through the rest of the day, closing at 302. Still profitable on this position, and it's our 3rd largest position chart still looks great. What else did we do when we had that breakout on the S&P 500? Let's go back and look at that again. We were net short on the S&P 500 with the repeated failure below the 21-day exponential moving average over the last 2 days. But when this move, when we got back above the 50-day moving average, and it stuck for almost about an hour, it looked like we may just get back above. We took we took 5% of SDS off, so basically we're even again on SSO and SDS, waiting for this to resolve in one direction or another. So small loss on our latest add to SDS, 0.06% of the overall portfolio, but the net short 4 buys that we've done were firmly positive net on that. So those are the only portfolio changes. Bottom line, continued tight consolidation, S&P, Nasdaq, Dow under the 21-day exponential moving average. So let's take a look at some support and resistance areas going forward here. The declining 21-day, we've been talking about it for 3 straight days now, 41.51. It'll be a little bit lower tomorrow, 41.50 or 41.49. 2 closes right in the vicinity of it. 4,100 below that is the lower range of this basing area. Basically, we're back in this range right now before we broke down in mid to late June on bad CPI, bad inflationary numbers. So there are some support and resistance levels. Let's take a look at some standout stocks today. First, we'll focus on what we own. Wolf is our biggest portfolio holding. Broke above this the high of the high volume gap up day. That's very much a positive. So we're getting some good returns. All 4 of our buys on this are now positive. Let's see what else. ENPH, we've got a small position in this. This had a good day after this bounce, undercut and reclaim of the 21-day exponential moving average on Monday. LNTH, we got stopped on a piece of this yesterday when it broke below the 80 level, and the ADMA bounced back nicely today, back above the ADMA. So we're still holding a small piece of that. I mentioned BJ's, SWAV, I mentioned that. ON up 1% today. We sold some of this on Monday. Still holding. We had as high as a 6% position. We sold 2% here and sold 2% here. Still firmly positive on our remaining position of this. So that's acting well, and it's a leader. And silicon carbide, Michael's going to do a deep dive into this. This is one of the factors driving some of these stocks higher in the podcast this weekend. Last weekend, he did a beginning to end talk on the nat gas sector. We're going to talk about silicon carbide in this podcast this weekend. What else do we want to look at? PanW, which we bought twice yesterday, consolidating nicely at the highs of the range from its gap up day. QLYS, which is the price leader, but not quite a big cap leader, not a big stock like you would like it to be. Near all-time highs today, consolidating nicely after this breakout from its earnings gap up. So this is 2 software security stocks that are acting well after their earnings report. Bodes well for the sector. Any other standouts today? Let's take a look at Celsius, which has been a leader. Made higher highs, pulled back within yesterday's range. Tesla tried to make a move today, was briefly above the 200-day moving average, but closed in the lower part of the range by the end of today. ENVX, a new name. Pretty liquid here. Big move up. I don't know a lot about this, but note silicon anode lithium ion batteries. Lithium has been acting very well lately. We all know that that's a key part of the EV craze going on. I read today that California banned the sales of gasoline vehicles after 2035. That's just going to continue to add to the industry demand for that. Here's Plug after a 5-6 day pullback right to the 21-day exponential moving average. A nice move up. Note the declining volume the last 4 days on that pullback to the 21. This is another stock that's benefiting from the green energy craze. Let's see what else jumps out at me. Bill had a gap up on earnings last week, pulled back for 2 days off the 80 MA, up 5%, but still under the declining 200-day moving average. Not a really good record lately for stocks like that are declining under the 200-day. It seems like they have a little bit of pop, maybe some short covering, but then they give it up. An example for that is Net, which we've been stopped out of. It's hanging tight along this 21-day exponential moving average. Maybe some volume will come in and push it off of there. But again, it's below the declining 200-day moving average. AEHR, which is too thin for us, but it is a stock that is benefiting from the silicon carbide. They do test systems for the semiconductor industry. Big move to higher highs. This thing looked great during the day, but look at a 5-minute chart on this. This was sold into and then sold off hard for the rest of the day. This is why you can't trust teenagers. I rarely buy teenage stocks, and this one only trades 1 million shares a day at 1665, so it's well below our minimum $100 million daily dollar volume liquidity standards. And I think that's going to wrap it. Nope, one more. Mosaic, actually a couple more. Mosaic. Fertilizer stocks usually act like energy stocks. They're breaking out. MOS with a nice move up today, up 6%. 3 after hours we want to talk about. CRM. Salesforce down 7%. Light on guidance. This is a broken stock under the declining 200-day moving average. It broke down shortly after it was added to the Dow Jones Industrial Average. Thank you very little. Let's take a look at Nvidia. Reported earnings. I read it's down 5%. I read that they reduced their estimated revenue for the next quarter by $1 billion. That's a lot of money. But to see it only down 4.5%, it's going to break below this 50-day moving average. We'll see what the reaction is tomorrow. A winner after hours, Snowflake, up 18% to 187, so it's right about here, still below the 200-day moving average. Again, most of these stocks that have gapped up, and even the gap up leaves them below the 200-day moving average, haven't shown much staying power for a continuing move. Some that have, like CMG, got above the 200-day moving average the next day and continued to show strength. So we'll see how that plays out, and that's going to wrap it. As always, you're interested in learning more about what we do at Revere, shoot me an email, don@revereasset.com, or phone 855-REAL-WEALTH. That's 855-732-5932. So wrapping up, Wednesday, August 24th, 2 days till Jackson Hole, Friday at 10 a.m., the big speech by Jerome Powell, 10 a.m. Eastern time. We'll see how that resolves. Remember, it's not how much you make in the market, it's how much you keep. No matter how many times a pie chart advisor tells you to not worry about it, if you're approaching retirement, you do need to worry about it. What if COVID wasn't a 0.01% death rate? What if it was a 4% death rate? Would we have recovered as quick as we did? I'm pretty sure we wouldn't have. That's why we have a stop strategy, a sell discipline. We can get out of the way, and then we've got rules to get back in when the wind stops blowing in our face. If you're interested, reach out to us. Wrapping up Wednesday, 8/24. Don Vandenbord telling it like it is. Thanks for listening and have a great day.